Alrighty, now I'm going to show you how I trade no touch. These are very easy some of the time. It depends on how the market's doing, what month it is, etc. But a lot of the times when you trade no touch, if you know this particular trading style, like no touch, when you make those trades, sometimes you can just be like, okay, like I already know this trade's going to win. Like, I can't even believe they're even allowing me to do this right now, because you can make a trade and know for a fact it's not going to lose just immediately. But you really have to know the system, because no touch in general isn't very easy. Now, I say no touch because I don't trade touch options. I just trade the no touch. Why? Because this particular system is designed to tell you what the price is not going to touch at certain times based on moving averages. I use the exact same chart, but let me just give you a few examples. This is gonna be interesting. But before I get into the examples, I'll tell you right now, one great thing about no touch is that with no touches you can do a spread. You can do a spread anyway, but with traditional binary options, doing spreads is kind of, I won't say stupid, but it's not very solid in general. But I mean, you can do it, but if you're trading less than like an hour out, then generally, there's no real point in doing a spread. But with no touches, it's a little different. With no touches, you can say the price isn't going to touch this level up top, and it's not going to touch this level at the bottom. And the one that has the higher probability, what you do is, okay, I have a 70, 80, 90% chance of the price not touching this level to the downside. And let's say I have maybe a 30%, or not 30, about a 60% chance of it not touching this level to the upside. So let's say I'm doing $100. Okay, so on the downside, I'm saying I'm not going to do, the price is not going to touch this level to the downside on this particular foreign exchange pair. And I'm saying, okay, it's going to be $100, right? So on the upside, if I want to hedge my trade, or if I want to potentially add more money so I can have a sweet spot, which is generally what's going to be a lot of the time, depending on how sideways the market is. But so the trade on the upside is going to be for $50, because you want to have the trade that's lower probability than the main trade that you want to be successful. You want that one to be 50% of the original trade. Why? Because if you are successful on the high probability side but aren't successful on the lower probability side, then you will still make money. But if you have it for the exact same amount on the lower probability side, you'll lose money, because you'll be at 50-50, and 50% in the money trades and binary options is not where you want to be, because you lose money every time. So why would you put the same amount on a lower probability trade? That's really stupid. So yeah, you do 50% of it. So you say you really want both trades to be successful. Otherwise, you should probably just do one trade and not hedge it at all, because you have also a situation with no touch and with any type of, well, not with any trade. Technically, with traditional binary options trading, you can make a spread to where one side has to be successful. But with no touch, technically both trades can lose. But you just got to make sure you don't do something stupid and make both trades lose. But I'll try to teach you as best I can how to trade no touch to where that doesn't happen. So let's start with this one. Now this is a very, very easy trade. Okay, this is on Great British Pound USD. See, I drew the line right here. This is showing the close. Great British Pound USD. generally closes on the 15-minute bars. So this is 3:30 in the morning. Well, this is 3:30 in the morning. Then this is where you want to be watching from, all the way back here and everything. But the reason why this trade is successful is because as you see, this red bar right here came way down here, even penetrated past this level of support, which hasn't even been reaffirmed as being a true level of support unless you go further back and see whether it is or not. But it doesn't really matter. Why doesn't it really matter? Because the EMA 13 has pulled through the EMA 233. It's pulled through the SMA 100. And back here pulled through the SMA 20, which is a signal in itself. But you have to be careful because the SMA 200 has a tendency to make price rebound. You have to be very careful about the SMA 100 and the SMA 200. So as far as its tendency to make price rebound off of it, so the price, even if it crosses through it, it rebounds a lot of times. Yes, as you can see, the price crossed through the SMA 200 nicely. Then the next bar is like, let's go ahead and rebound. So gotta be careful with that. But this right here is a put signal. Price came down here, retraced back to the EMA 13. You do a put right here, a traditional put. So this traditional put generally is going to last like 15, 20, 25 minutes. You don't want to do a trade on a 5-minute chart more than 25 minutes out using my particular strategies. None of them. None of my strategies. But yeah, so this is where you make the trade, because I think it's a 7-minute lockout for a Great British Pound USD. So yeah, at some point on this bar, they're letting me say that the price wasn't going to touch here. Now, okay, so the price was probably around here when I made the trade, because I was trying to make the most out of the trade. So I was probably trying to wait until the price came to this area to make sure I could get, above the SMA 50. That's the key to this trade. You want the price to be above the SMA 50 as far as the no touch. The price isn't going to go above the SMA 50. It's just not going to happen, because SMA 200 is right there, SMA 13 is right there, 233, EMA 26, SMA 20, SMA 200. And as you can see, the price action, not above the SMA 50, not above the SMA 50, above it, came down. Above it slightly came down, above it slightly came down, here it came down, here it came down, here it came down. But now it's got a whole lot more levels of resistance here as far as moving averages, so it's not going to get to it at all. And even if it does, I have support. I have some leeway right here. You'd have to go up to the SMA 200, SMA 100 for me to lose. Which, if you look at it, also part of the reason this is a put signal right here is the the MACD right here is very diverged. You want to look at this line right here and see how much it is down from this line. You also want to see the stochastic right here. It's also diverging. It's not even quite touching the 20 line, which once it touches the 20 line, you have to worry about a potential rebound. But it didn't touch it yet, so you don't want to pay attention to the momentum. There's something I was just playing around with the momentum, but I don't. The momentum bar is pointless for my strategy, so don't even pay it any attention. Don't even put it on your charts. Yeah, so that's one. Oh yeah, and they close right here. Easy win. You could actually do a no touch here, and you could also do a traditional trade for a put right here. Technically, you're doubling your potential trade as far as a loss, but this is like a I would say it's 100% chance of winning, but yeah, most people don't like to say that in trading. Nothing's ever 100%, but I like to say that, so we'll just go ahead and say there's 100%. successful trade ratio for that probability. Next one, no touch here, is based on the same type of thing. However, this is in an uptrend, as you can see, but it's been in the sideways market for the past hour or so, or for past 30 minutes. And as you can see, took the trade here. I made sure this trade was was really close to being finished. I pretty much took the trade right before the expiration, which is because as you can see, it's an uptrend. The stochastic crossed right here as well, but I took the trade because, as you can see, you have the EMA 233 right here, SMA 50 right here, SMA 200 right here. So I took the trade above all of those, and the EMA 13 is in between the 20 and the 26. So that says, basically, it says it's a sideways trend. So yeah, you do a no touch here, trade closes here, next bar it would have lost. That's why you take the trade short, because you have indicators telling you that it's an uptrend, so you have to be careful about your timing, which is, you'll learn. I can't completely teach you the timing aspect of it. I can only just help you. You can just ask me questions, email me, or whatever. That's one of the harder parts, but I'm trying to give you a good understanding of how to time the market using this particular strategy. Here's another one. Market sideways. You can look at the EMA, the MACD sideways, stochastic sideways. Then you can see there's a level of support right there, but it actually closed right here. So, and it's just a coincidence that the SMA 200 just happens to be right here at the same level of support as this. So that makes this level even stronger. So, and then you wait for it to prove this level is strong, which you don't even have to do. But I did that because this is Euro JPY. It closes on the 00s and the 30s, on the hour and the 30 minutes. So as you can see, this bar closed really, really weakly, which just confirms the continued sideways movement. So you do a no touch here under the SMA 200, and it's a successful trade because it closed right here at 2 p.m. Yeah. I could do this all day. Okay, let's see. Oh, okay, this is more like what I was talking about. This is a no touch spread. I labeled it so I can make sure I can understand, because I did this a while ago. This was a very old trade, actually. So April of 2012. There's a low loss. So this was in the money because this low loss, and I took this trade because it was under the SMA 200. But the trade that I really liked was the no touch to the upside, because this is also a put signal, because the 230, the EMA 13 right here has proven itself as a put signal. So I took the trade after it proved itself as a put signal, and I got this particular price. And it closed. Where did it close at? Can't see my line. I'm not exactly sure. I'm not exactly sure where this closed at. I don't think I drew the line. But let's see. This is Euro USD, so I believe it closed. Might have closed. Okay, this is where it closed. There's the line. I didn't even see it for some reason. I'm blind right now. It closed at 5 in the morning. So it lost to the downside. Now what I could have done, which is what I do some of the times, which is why these no-touch spreads are so great, You do, let's say, $100 here for no touch. Price doesn't touch there. That's a successful trade. You do a $50 trade here. It loses. Doesn't, well, it matters, but it you still are in the money. You're just not in the money as much as you would have been. But what you do, if you say, okay, this isn't gonna touch here, what you can do is say, okay, I'm using 24 option. I can close my trade out because they allow you to do that, and then I can still take a loss, but I'm not going to take as big a loss on the $50 as I would have. So my profit's going to be even higher because I exited the trade because I was wary of the fact that the price might penetrate under. Now what you can also do is do the same way. You can say this trade is for $100 higher probability. This trade is for $50 lower probability. But what you can do is say, okay, whoops, this trade actually isn't as good as I thought it was. This lower probability trade is actually proven to be more in line with what I wanted to do than the other trade that I had higher probability on. Let me just exit out of my higher probability trade. And you can potentially exit out your higher probability trade in the money on that trade, so you can make money on that trade even though it would have potentially inevitably ended in a loss. So you make money on that trade even though it might have been a loss, and that happens sometimes. And then you make money on the other trade that you had lower probability on. So it's a lot of little things you can play around with the spreads. It's pretty fun. Here's a spread. Both of these were successful. This is a sideways trend. This is an easy one. Well, it's not super easy because the EMA, the MACD is crossing right here. But look at the price action on the EMA 26. Touch right here. Rejection, upside. Touch right here, rejection, upside. So you see this bar right here, it stays close, rejection off of that again. Plus it's the doji and then another doji. So right before this doji finished forming, you take a trade for no touch to the downside, and then you also have no touch to the upside. This one is because it's also, like I said, in the sideways trend, and the EMA the MACD is down like this. So I probably had the most weight. Let's see. Yeah, I was about to say I probably had the most weight on the no touch for the high side and the lower weight, the lower probability on this one. So let's say I had this one for $200 and this one for $100, and both of them are successful. But part of the reason this is also a higher probability is because of this price right here being a level of support. A level of resistance. You can see this right here, and the price is there, and then you have the EMA 233. So, and then the stochastic and MACD also have to confirm it. It's pretty simple trade. 315 it closed, so the next bar would have actually lost. You have to be careful about your timing on certain things like this, because the EMA 13 is above. It's been in an uptrend like that, and since it's above, you have to be careful of it being an uptrend. So that's why you want to trade this very short time frame. Boundary, do this one. Let's do a couple more. Oh, this one's a nice one. I probably did a no touch low on this. Yeah, no touch spread low, high loss. Yeah. So yeah, I said the price wasn't going to go under here. That was a really obvious trade. If you go further back, you can probably see that there's a level of resistance right here. But yeah, so you have your level of resistance here, slightly right here, but that one doesn't matter anymore because it got crossed here, price here, but then you had the touch of the SMA 100 right here. So you do a no touch to the downside, and then you do a no touch to the upside just to hedge the trade because it was actually pretty close to being under. Sometimes the price will go under the SMA 100 and then close above and then go up. So if you had done a traditional call here, you might be successful on this trade for the upside, but on a no touch it might drop under, then come up, and then go up. So sometimes the no touches can be detrimental, but in this case it wasn't. But that's why I hedged it, because it was unlikely for both of them to lose. It's potentially both of the trades could have lost in this if that would have happened. Let's see what else we got. Let's get a good one here. Let's do one more. I'll just do this one. Yeah, whatever. Okay. This is an interesting one. I actually don't even want to do this one. But anyways, because I'm not really sure when I took this trade, it's kind of important to know what part of this wick I took this trade on. But let's just say I took the trade at the wick when it was here or something like that. Actually, let's see what time it is. 45, 50. So I had to take the trade before this wick, before this bar closed. So I probably took this trade right before the bar closed. So it's probably pretty close to this, but I took it because this wick went down so far, which was going to drop the EMA 13 close to being through the EMA 26. But we'll do another one. I don't like that example as much. You have to study some more of these screenshots to really fully understand that trade. Plus, it's not as high a probability as the other ones. Try this one. That's better. $15. This one I'm trying to understand why I didn't do a no touch to the downside here. I probably might have been too late. I might have done this at the last second or something. But this is amazing no touch to the downside. However, this is a put signal, so price going down here, EMA 13 crossing, and MACD is crossing, stochastic crossing. So this is a put signal. That might be why I didn't do it, because trading on contrary to the put signal, which causes a lot of losses sometimes. So I didn't do that, but there's a lot of support here on that EMA 233. That's why I use the EMA 233, because it creates a lot of support. But anyways, I took the trade as a no touch right here because the EMA 13 is dropping, which is why it's a put signal, and that's why I took the trade, because of the put signal for a no touch to the upside. But yeah, just keep practicing looking at these screenshots. You're gonna start loving no touch on certain weeks, certain months, when it's really easy. So